This is the India development debate right here on ET Now. I'm Supriya Shrinate. Right now, we're going to be putting the focus on what the RBI has done. But coming up at 9:30 p.m., we're going to talk about the oil carnage in the markets today and where does this leave the OMCs. Are we turning our backs on fuel deregulation? That's the big question. And who is responsible for the carnage on the Law Street? All of that is coming up at 9:30 p.m. But for now, let's keep the focus on RBI. A status quo policy from the central bank, but the market is not liking it. After a two-day meeting, the Monetary Policy Committee headed by Governor Urjit Patel voted against an interest rate hike even as the policy stance was changed from neutral to what they're now calling calibrated tightening. Explaining the rationale behind holding the rate steady, Dr. Patel indicated that the two previous rate hikes are still doing their job despite a breather from the RBI. Stocks fell like 9 pence post the policy announcement. Rupee plunged to an all-new low of 74 to the dollar. Many blame it on the governor's comments that the RBI's focus is on containing inflation and inflation alone. There is also a fear that the decision to hold back a rate hike at this point in time could pose fresh macro challenges for the Modi government. The key takeaways from the policy announcement, what they mean, why is it that markets in rupee are unimpressed. We are joined by a stellar panel of guests right here on the India development debate this evening. I've got Maithili Busnurmat, our consulting editor right here on ET Now. V. Anantha Nageshwaran, the Dean of IFMR Business School, Kriya University. Rashesh Shah, President FICCI and Chairman and CEO Edelweiss Group. HR Khan, former RBI Deputy Governor. So thanks each one of you for being with us. And Rashesh, if I may begin with you, look at how the markets fell. Look at what happened to the currency. The markets were down 900 points at one point in time. The currency going past 74 to the dollar. There was absolute carnage on both the currency and the equity markets. Is there a crisis of credibility? Because the markets and the rupee don't seem to be trusting anything that either the government or the RBI is telling them.
No, I don't think there is anything you can blame the government or RBI. I think they are doing the best. Government has cut fuel, excise on fuel and all to bring down prices. RBI has not increased rates today, which is a good thing because they want to give more room for the economy to grow. What we are seeing is our global headwinds largely. Oil price going up, US dollar becoming stronger, US interest rates going up. So this is not just India, this is an emerging market sell-off because that carry trade which was there where because of quantitative easing, there was a lot of low interest cost US dollars available, which are all starting to go away. So this is a global phenomena. We are part of that. Unfortunately, oil price impacts us a lot. But in the middle of that, I would think RBI and government have done all that they could to at least make sure things don't get worse.
I don't know if others on the panel agree with you. And Anant, let's come to you on this. The markets don't seem to be impressed. The currency markets are certainly not liking this. Are you going to account this all to global factors, or is there really a loss of face, a loss of credibility? Are the markets and equity, equities and currencies not trusting what the RBI or the government is telling them? Is there crisis of confidence?
If you go by the market action, I think there is a credibility issue, but however, RBI's situation is somewhat difficult to, somewhat easy to sympathize with because they are betting on the fact that Indian domestic food prices have behaved rather well, surprisingly better than expected. And if you read the monetary policy report, they are also counting on the trade wars creating a global economic slowdown and demand slowdown for crude oil, helping to mitigate the prices. So they kind of feel that on a baseline incremental basis from the last policy meeting, the inflation situation looks favorable, but the risks are still there, and that is why this calibrated tightening. So they thought that they have covered themselves with a non-action response consistent with the inflation outcome that has happened so far. At the same time, they are also looking at future inflation risks and covering themselves with calibrated tightening. So I'm sympathetic to the point of view that this is part of a global sell-off that was bound to happen anyway, and attributing it solely to lack of credibility is not fair. But there is a certain credibility issue to it. As always, the truth lies somewhere in the middle.
The truth lies somewhere in the middle, and Maithili will be candid enough to tell me where the truth lies. Maithili, I know the early comment that you made when we were having a chat on this afternoon was that there almost seems to be this very narrow, microscopic view with which this policy formation has happened. The governor has justified it, essentially saying that MPC's mandate or the legislation is to talk about and to target retail inflation. Are they wrong to do so?
Well, yes, Supriya, I'm very conscious of the fact that central banks don't take kindly to criticism, and at the risk of burning all my bridges with the central bank, I must say that I think the RBI has taken a very narrow view of inflation after highlighting all the various risks. And mind you, monetary policy must always be forward looking. But despite highlighting all the risks, and today everybody would have, almost anybody, clearly I am in a minority vis-a-vis the RBI over here, but there was a very strong case in fact for hiking interest rates, not only because of inflation going ahead looks as if it's going to rise, because we're seeing the dollar strengthening, we're seeing US Fed likely to raise interest rates, we're seeing oil prices go up. So we also have this strong possibility now that the fiscal deficit might get breached despite whatever the government might say. So we had all these reasons to in fact increase interest rates. Also remember, the current account deficit, the problem is solved partly by containing demand, which already done with the rise in interest rates, and also on the financing front, if you had hiked interest rates, you might have seen some higher inflows. So there were all the reasons for you to hike interest rates by at least 25 basis points. Markets had factored that in. In fact, the market reaction, though of course one must take it with a pinch of salt, was precisely because the RBI's action was so illogical. The story and the conclusion just did not fit, and that is almost entirely because the RBI, as the governor asserted, is monetary policy is exclusively focused on inflation targeting. That's not the way a central bank in a developing country should work. It needs to take into consideration other macroeconomic fundamentals too, and here the RBI clearly fell short.
Fair point. Hold that thought. I'm going to go across to former RBI Deputy Governor, Mr. H.R. Khan here. And Mr. H.R. Khan, while Maithili has been very candid, the big worry, and I'm going to share something that a lot of experts on the streets are telling us, is that it almost seems that RBI or MPC have these blinkers on, and that's how this policy has been made. How are you going to defend your former institution?
No, as has been mentioned by Governor in the press conference, that RBI's legislative mandate is inflation targeting, so they are exclusively focused on inflation. But one has to keep the overarching preamble of Reserve Bank, which is also talks about financial stability and growth, and Reserve Bank in a sense is a systemic risk manager of the country. I think that role also has to be fulfilled. To the extent that there is a MPC framework of inflation targeting, he is right, but that's not the whole part of Reserve Bank's mandate. I think financial stability is also a very important mandate of Reserve Bank, even though it doesn't flow from the MPC framework, it flows from the RBI Act, if you take the entire gamut of RBI as a full service central bank into account.
You know, I do want to shift the focus away from this and talk to each one of you on what really happened with the rupee. And Rashesh, I think it's only fair that we talk about the rupee because it reached historic lows of 74 to the dollar today. Obviously, markets are worried on two counts. I don't know if they're worried about the fact that rupee wasn't spoken about enough, or are they worried that there may be something that may happen outside of the MPC? I mean, what explains no action to rein in the rupee? Is the RBI also signaling, and is that what the rupee reacted to, that the central bank is perhaps fine with the rupee depreciating? The central bank is perhaps fine with the rupee finding its level. At least that's what Veera Acharya did say, that rupee and dollar is a very deep market, and it should find its own level. They're only there to defend the currency against acute volatility, but not to defend a certain level.
Absolutely. I think ultimately using interest rates to protect your currency works only if there is an emergency. Currently there is no emergency. I think the rupee is finding its own trajectory. It's not always that a falling currency is only about pain. It's also about your cost competitiveness getting restored. It's also about your exports getting a boost. So I think we have to see this in the holistic, and we should see the rupee on a 5-year period or a 10-year period. And I think rupee depreciating by 3 to 4% per annum over a 10-year period is the phenomena, and we are in that trajectory only. So I would say idea is not to panic, idea is not to suddenly see that, oh my god, the falling rupee is very bad. I think in order to protect the rupee, the only choice RBI had was to raise rates, which they have not done, which I think is a good thing.
Okay, hold that thought right now, because I'm going to get Anant Nageshwaram back in. And Anant, Rashesh tells us don't panic and, the rupee will find its level and all of that. But where is the bottom? And why is the rupee sulking so much? Is the rupee not happy that the RBI is not talking about it? Because the RBI in its policy made it very clear. The MPC's mandate is inflation and inflation alone. Are markets or rupee really worried about what may happen of the unknown? Do they fear the unknown action that may follow up outside of the MPC really? Or do you believe the rupee believes that the RBI is not very worried about its depreciation and so it continues to fall?
I think RBI is probably right not to talk about the rupee and focus on its mandate, and in the sense that if you get inflation under control over the medium to long run, the currency will also attain stability. In the short run, I think it could be driven by sentiment, and maybe the RBI is also right in letting the rupee weaken through market action, because it will be a negative, it will be a restraint on imports, which is what India needs as well. So, and as we all know, in the last couple of weeks, dollar has once again regained its strength on the back of the Fed action, on the back of what's going on in Europe, etc. So again, I don't think we should isolate the action in rupee alone and blame the central bank. As long as the rupee depreciation is happening in a manner that is consistent with what's happening elsewhere, which I think is the case until now, I wouldn't worry about the fact that it has breached historical levels, etc. That is all par for the course. Ultimately, medium to long run, inflation is the sole driver of the currency, and India's inflation rate is higher, and therefore it has to depreciate, and what is happening right now is consistent with that. And RBI's lack of commentary is in a way an indirect way of saying we are not panicking, and that to me is a reasonable course of action to be taken.
Maithri, you agree with Anand that the RBI doesn't need to talk about the rupee. I mean, it's all right, and this is a reasonable course of action to be taken. The action may follow or may not follow outside. Or are you someone who believes that, and I'm just going to step and make this a larger debate and not just concentrated about the rupee, but do you believe a rate hike perhaps today could have served various purposes? It could have looked at forex, it could have looked exchange rate, it could have perhaps reined in the CAD, and which would have had a positive impact on the rupee, and also would have invited or wooed the inflows. I mean, the FPI outflows from India are pretty alarming right now. And do you believe that purpose could have also been served had this not been a myopic approach to just targeting inflation? Because they overshot on their target, they didn't have to act today.
Well, I would agree with you, Supriya, on that, because as I said earlier also, a hike in an interest rate does not directly affect the exchange rate, but the way it works is by restraining both the CAD, the CAD, the current account deficit, as also incentivizing at least debt inflows. And as you can see, the RBI is not averse to debt inflows, because what they've been doing over the past few days is try to encourage further external commercial borrowings. So there cannot really be the argument that we didn't want to encourage debt inflows. Having said that, the fact is, yes, it is true, no central bank ideally in a floating exchange rate. And mind you, we have what is known as a dirty float. So you do not fix a level, you try to reduce the volatility, which they've been doing. But as we saw in 2013, finally when push comes to shove, it is the RBI which acts. So the central bank cannot be indifferent to what happens to exchange rate, particularly when the exchange rate feeds into inflation. As we've seen, one of the reasons why fuel prices are rising so dramatically in the country is not only because oil prices are rising, but also because the rupee is depreciating. So to pretend that we are indifferent to exchange rate because it does not affect even our inflation, that is very, very myopic, because it clearly does. So even if you are a pure inflation targeter, there is no central bank which can afford to ignore what is happening on an exchange rate, which is why we've seen countries across the world, whether it is Philippines, whether it is Indonesia, they've all raised interest rates. And we're not talking, mind you, of extreme outliers like Argentina and Turkey. So which is why I said the markets reacted the way they do, because if the RBI is behind the curve, then as and when it acts, it'll have to come out with a much harsher measure. Interest rates will be hiked much more dramatically. So So a stitch in time saves 9.
That's an important point, and let me actually just go across to Anant Nageshwaran and get his views on this before I move forward in the panel and go back to Mr. Khan. Anant, don't you agree with Maithili that today you may have not acted because you said that your purpose was to target inflation, and that's what you're doing. But tomorrow, and you know, the central bank has perhaps given out the right signal that it's all right if the rupee depreciates. It's not our job to defend the level of the currency. We are here to actually hedge it against acute volatility. But tomorrow, if the depreciation were to be sharper, you will have to step in, and that may be a costlier or dearer. It may have a higher price tag to it.
No, we have to accept the fact that much of it is a hindsight reaction. Suppose the RBI had raised interest rates by 25 basis points, and let's say the market had reacted negative, then we would say the RBI, by hiking interest rates despite marking down its inflation forecast, was signaling panic, and therefore the market reacted nervously. We would criticize the RBI for being panicky. Now, what they have done is they have marked down their inflation forecast compared to the last meeting, and therefore you can't say they are behind the curve. And the market reacted negatively, and therefore we are saying the RBI is being indifferent to exchange rate. So I think we need to understand that in these situations, the outcome is a toss of coin, and most of our analysis is based on the market reaction, which in itself is not necessarily the most rational one in the short term. So that is why I'm saying these are 50-50 calls, and it is much easier to be wiser in hindsight. I don't think from its inflation standpoint it's behind the curve. The depreciation is indeed appropriate with Indian fundamentals, and so far it has not really overshot to alarming levels, and therefore on balance up until now I am still prepared to give the benefit of doubt to RBI's approach to this issue.
Okay, you are prepared to give the RBI's approach to this issue, and that's the balance. Mr. H.R. Khan, you know, when we talk about these interesting times and very extraordinary times, we talk about extraordinary circumstances and extraordinary policy reserves as well. Now, many people believe that if there were to be a simple swap window for OMCs, it would have solved a lot of the problems. Why is the RBI not looking at simple things that have been done in the past and have served a purpose?
No, the specific case, I will not know what would have gone, how much is the requirement, but they have opened that ECB window for the oil companies. And for example, in this regulatory and development policy, they have brought out a very interesting concept of voluntary retention route, where the FPIs can be allowed more freedom in terms of bringing flows, provided the flows, the amount can be locked in for a period, say 3 to 4 years or 5 years. I think they are concerned about rupee volatility, excessive volatility, and the risks arising out of free fall of rupee. But in terms of what they have communicated or what market has perceived, I think probably there could be a question mark.
Okay, that's an important point coming from a central banker himself. What they have conveyed and what the markets are perceiving, there could be a difference. But I wonder why are they not trying to bridge that communication gap. But you know, Rashesh, it's only fair that I ask you the question, because this is the question on every investor's mind today. That can the government and the RBI look the other way, or can they afford to ignore the significant erosion of wealth that's happening right now? I mean, all of 2018 gains have been wiped out in 1 month alone. There are retail investors who've made a comeback to the market. There are people who invest very hard-earned savings in mutual funds. I mean, what happens to people like that?
I don't think government or RBI should worry too much about stock market going up or down beyond a point. So if the gains are being wiped out, I don't think there is any need for RBI or government to do anything to specifically protect that. I think stock markets go up, stock markets go down. Investors should be aware that market corrections are very sharp and brutal, but markets also go up when economy is doing well, when earnings are going up. So I think equity investing comes with the equity market volatility, and I think it's very unfair for us to expect government or RBI to do things to keep equity markets in mind. I think they have to keep the overall economy in mind, they have to keep inflation in mind, and in that, even the government action on IL&FS, I think, has been very responsible. The way they acted, the decisiveness they have shown. So I personally think, given whatever is going on, whatever government and RBI is doing is to the best of the the instruments they have in their hands.
Okay, let me take this across to Maithili and Anand both, because I think this was an important discussion that I meant to have. And Maithili, a statement from the governor that says that they welcome the action that the government has taken, which is appointment of the new board, and they will speak to new management and board if required. Then, of course, Mr. Vishwanathan, the deputy governor at RBI, in charge of the division, turns around and says that this is just an aberration, don't treat it like this. Viral Acharya goes on to say, you know, this is rollover risk. This is too much appetite for increasing market share. There's too much CP with NBFCs. I mean, are we brushing aside as India's central bank? Can they afford to brush aside IL&FS as an aberration? Look at what IL&FS has done to our markets. Look at what IL&FS has done for the NBFC pack. I mean, you know, I'm just asking I'm actually thinking aloud. Are they living in denial on IL&FS?
Well, I would agree with Rashish to the extent of saying that yes, investment in the capital market is subject to market risk. So to that extent, one doesn't have to worry about, you know, protecting those who invest in the capital market. But to say that IL&FS was just an isolated instance and that there's no worry on the NBFC space is to be very naive and to expect the market to believe you. Because the fact is that the RBI is the regulator for the NBFCs, and the fact is that NBFCs grew very dramatically and much in excess of what the justifiable growth, precisely because you had imposed so many restrictions on banks and because of fear psychosis in the banks. So the RBI needed to owe much more, you know, responsibility for what is happening in the NBFC space, and so that they, you know, reassure people that we will provide enough liquidity, and NBFCs are an issue, and the reliance on wholesale deposit market is not a very wise thing. So I think these kind of reassurances from the Reserve Bank of India about the way it manages NBFCs, how it is concerned about financial stability. There is really no mention in the statement. Of course, in the post-statement conference, there was some mention, but it was not sufficient to assuage fears. What is the RBI doing about the NBFC space? Also, had you increased interest rates, maybe there would have been some increase in household savings and financial assets, because today we are seeing that household saving in financial assets has been coming down. So these are all macro concerns that the RBI policy should also have addressed. So to describe IL&FS as just an isolated instance and to brush away concerns, I think is taking it very mildly.
Okay, Anand, very quickly, is the RBI in denial? Is the RBI treating the IL&FS issue too mildly than it should? I'm running out of time. I'd like you to be brief.
Well, I think, on balance, I would say the answer is yes. I was supportive of the action they took, which is no action. But communication, you have to get the right balance between not creating a panic, at the same time acknowledging the reality. And probably there that balance was not struck properly. And Maithili brought out good issues about RBI being the regulator, etc. And therefore, one needs to express the right amount of concern and also display the confidence that they are on top of things. But not expressing a concern is to give investors the impression that you are not even acknowledging the reality, and therefore that is problematic. But the markets can indeed go up and down, and we don't ask RBI to intervene when the market is going higher, and therefore asking the RBI and the government to intervene when the market is falling is not a very symmetric behavior on the part of commentators or investors. So that part of it we can ignore. But the IL&FS issue, I think what they need to strike the right balance there, and probably they failed in doing so.
Okay. They failed in doing so, but on that note, completely out of time as far as this edition of the India Development Debate is concerned. Can't thank this wonderful panel enough. Mr. H.R. Khan, Rashesh Shah, Anant Nageshwar and Maithili Bhusnurma. Thanks very much for being with us. We take a quick breather and we come back and put the spotlight on where it matters. And that's another set of asset value erosion that's happened. 1.25 lakh crore wiped out from the Indian markets on account of the losses suffered by India's energy companies. Is the government now turning its back on fuel deregulation? Come back and discuss all of that in just a bit. Stay right here with us.